One book at a time. Today's selection is Psychology of the Stock Market.
Have you ever felt like the stock market is like a maze? It is a world where logic seems meaningless, where numbers dance crazily, and your decisions keep repeating a painful circle of buying at the peak and selling at the bottom. Are you tired of the feeling of helplessness, of being constantly led by emotions into dead ends that you could have avoided? If the answer is yes, then today we will open a door together. It is a door leading to a deeper understanding of ourselves and of the volatile financial world that we are a part of. The book I want to introduce to you today is titled The Psychology of the Stock Market. It sounds academic, doesn't it? But believe me, because it is not just a book. It is a mental map and an inner compass that helps you navigate through the vast sea of chaotic information. What is special is that it was written more than a century ago by a man named G.C. Selden, yet its value remains intact, perhaps even truer than ever in this turbulent digital age. It is a reminder that no matter how much technology changes, human nature and our fundamental emotional drivers will always be the factors shaping the market. Before diving into this precious content, allow me to share a bit about the perspective we will explore together. I am not a financial expert defined by degrees or impressive profit figures on rankings. Instead, please see me as a friend, an elder brother who has experienced all levels of emotion on the investment path. I am someone who has tasted the sweetness of victory as well as the bitterness of mistakes and hasty decisions paid for with sweat and tears. So what is our goal in this journey? It is very simple, but extremely powerful, which is to help you stop buying at the top and selling at the bottom, the cruel cycle that many investors fall into, even the smartest and most knowledgeable ones. How so? Not by some tricks or magical formulas to predict the market accurately, but by understanding ourselves better about the two lifelong enemies that are also the two most powerful drivers in the market, known as fear and greed. We will together peel back each psychological layer and shine a light into the hidden corners of the subconscious so that from there you can make wiser and calmer decisions, and most importantly, decisions that suit who you truly are. This is not a get-rich-quick course, but a journey of self-discovery, an invitation for you to look deep inside to find the piece that has been missing for so long in your investment picture, which is the piece called psychology. Let us begin this trip together. Chapter 1: The Speculative Cycle, when the crowd is always wrong. Have you ever wondered why the stock market, despite being considered a place of logic and data, frequently plays out such irrational scenarios? Why a stock can skyrocket without a clear reason and then collapse uncontrollably? The answer lies in the laws of crowd movement and how it directly impacts prices. The stock market is not a straight line, but a series of cycles, up and down, like the breathing of a giant organism, and each breath is tied to our emotions, the people participating in it. Imagine a classic cycle, beginning when the market is at its peak and everything is filled with extreme optimism. Good news surrounds everywhere as companies continuously report impressive profits and analysts provide sky-high forecasts. People talk about stocks everywhere, from cafes and dinner tables to social media forums, making everyone feel like an investment genius. Money seems so easy to earn that you think you cannot lose, and even your friends or neighbors who never cared about finance start asking which stock to buy. This is a time of extreme euphoria and a blind belief that things can only get better. Then, the cycle reverses when the market is at the bottom, creating a completely opposite picture of extreme pessimism and despair. Bad news floods in while companies report losses and experts forecast a long, dark period. People start to feel panic and fear, so they no longer want to mention stocks, even feeling a sense of loathing. Accounts continuously lose money, and the feeling of despair makes people sell everything to cut losses in order to escape this nightmare, while swearing never to return to the market again. This is a repetitive pattern over decades, not just in the stock market, but in any other speculative market. So when is the time that the crowd feels safest to buy in? It is exactly at the peak of optimism, when prices have skyrocketed, when everyone is buying, and the best news has all been announced. Think about this. If everyone you know is buying a certain stock, and that stock has doubled or tripled in value in a few months, you will feel safe jumping in because everyone is making money. You fear missing out and fear being outdated. But this very feeling of safety is when it is most dangerous. The reason is that the price has reflected all the best news. So when all positive information has been released and the price has increased accordingly, there is no significant motivation left to push the price higher. Additionally, there is no one left to buy in at a higher price, because if everyone who wanted to buy has already bought, and those remaining are extremely excited, then who will continue to push the price up? Smart investors or big players who bought in earlier are now quietly selling out to transfer their profits to newcomers who jumped in with the belief that prices will rise forever. More importantly, emotions have blurred reason. So at this point, your decision is no longer based on real value analysis, but on the feeling of fear of missing out, also known as FOMO, and overconfidence. When you feel safest to buy in, that is also when the risk has reached its highest level. Conversely, when everyone is most afraid and the market is immersed in pessimism and despair, that is when the opportunity to buy at the best price appears. This is one of the most expensive lessons and also the most difficult to implement in investing, because our natural instinct as social creatures is to follow the crowd, to seek safety in the collective. We want to be accepted and do not want to be outcasts. So in the market, this manifests in wanting to buy what is rising in price and sell what is falling. We are caught in the wave of euphoria when prices rise and panic when prices fall. But if you follow that instinct, the usual result is that you will buy at the peak when everything is safe and everyone is buying, only to sell at the bottom when everything is dangerous and everyone is panic selling. Ultimately, you buy high and sell low, which is the fastest way to lose money. To make money sustainably in the market, you must do the opposite of natural instinct by buying in when the crowd is afraid. When the market is immersed in pessimism, along with cheap prices, and no one wants to mention stocks anymore, that is when smart investors start accumulating goods. This requires extraordinary courage to go against the emotions of the majority in order to face doubt and even ridicule. At the same time, you need to sell when the crowd is extremely excited. When everyone is celebrating victory and the market is filled with excessive optimism and prices have risen to unimaginable levels, that is when you should start taking profits. This is also not easy because it requires you to suppress greed and ignore promises of irrational profits that will continue. This requires iron discipline, along with extraordinary patience and a cold head to discard personal emotions and noise from the crowd. So what is the first lesson from Chapter 1? It is that the stock market is not just a game of numbers, but also a psychological arena. The crowd with emotions of euphoria and fear is always the factor shaping prices and creating cycles. So to succeed, you must understand this rotation, and more importantly, have enough courage to go against your own natural instincts when necessary. In the next chapter, we will dig deeper into the specific psychological mistakes that investors often make. Chapter 2: The Trap of News and Events. In this chapter, we will unveil one of the most confusing things for new investors and even experienced ones, which is the relationship between news and price fluctuations. This is a relationship that at first glance seems direct, but in reality is full of psychological traps. Have you ever experienced this feeling when a company you are following suddenly announces outstanding business results or a major contract worth billions of dollars? News floods in, and everyone shouts that this stock will fly high. Yet, ironically, after the day that good news is officially announced, the stock price drops, even sharply. You are bewildered and confused and wonder what you missed, or if good news is supposed to increase the price. Well, my dear friends, you are not alone, because I have been caught in that whirl of confusion countless times when I first joined the market. And that was when I realized one of the golden principles and an almost constant truth that I want to share with you today, which is buy the rumor and sell the fact. Let us dissect this saying, buy the rumor and sell the fact together, because it sounds a bit unethical, like taking advantage of unofficial information. But actually, it describes very accurately how the market operates based on expectations and crowd psychology. Imagine this as a large technology company called TechCorp, for short, preparing to launch a new breakthrough product. Months before the official announcement, rumors begin to spread, possibly from insiders or from analysts or from other sensitive information sources. Shrewd investors and sharks, or even individual investors with research capabilities, will begin to sniff this out, and they start buying TechCorp shares. The price starts to nudge up slowly and quietly to reflect the expectations of a group of people. When those rumors become more popular, more people start to believe in the potential of the new product, and the fear of missing out, or FOMO, begins to emerge. Cash flow into TechCorp becomes stronger, pushing the stock price up, and by this point, the price has increased significantly because most of the potential from the breakthrough product has already been priced into the stock by the market, meaning it has been discounted into the price. And then the big day comes when TechCorp officially holds a press conference to announce the new product, and it is truly as breakthrough as everyone expected. Good news floods the newspapers along with television and social media, making everyone clap and praise. But do you know what? Those who bought the rumor beforehand, who were the people who bought when the price was still low and the potential was not clearly seen by anyone, they are starting to sell the fact. They sell to take profits because for them, this information is no longer new, since it has been predicted and reflected in the price for a long time. So why does the price usually fall when good news is officially announced? That is precisely because the financial market, and especially the stock market, is an extremely efficient future discounting machine. It does not reflect what is happening today, but tries to reflect what will happen in the near and distant future. Imagine the market as a prophet, with a giant crystal ball constantly collecting and processing billions of pieces of information from financial reports, statements from the chief executive officer, industry trends, macro policies, down to the smallest rumors on social media. All are analyzed by this prophet to predict the future of a business or an economy. When positive information is about to happen, such as good business results or a new product or a large contract, the market does not wait until the day that news is officially announced, but starts discounting that bright future into the stock price right now. Smart investors and large funds have the resources and analysis teams to predict in advance and act early. Therefore, by the time the good news is announced, it is no longer a surprise, but merely a confirmation of something the market already knew, predicted, and priced into the stock. Sometimes, the announced good news is even not as good as market expectations, and then the selling pressure will be even stronger. And when there are no more elements of surprise or expectation to drive the price up, those who bought in earlier based on those expectations will start to take profits. The selling cash flow overwhelms the buying cash flow of late investors, and thus the stock price falls. This is a very common psychological cycle, going from expectation to price increase, then to reality, and profit taking, to finally a price decrease. This does not mean that news is not important, because news is indeed very important. But the problem is that we need to understand its role and timing. News only truly creates strong fluctuations when it is different from what the market predicted and discounted into the price. So what is the lesson we draw here? It is to never just react impulsively to news headlines, and do not think that a good news will obviously push the price up. The market is much more complex than that, because it is a living entity that is constantly looking ahead and constantly pricing what might happen. Our task as sober investors is to try to understand whether that news, whether good or bad, has been digested and discounted into the price by the market or not. We must ask whether this news is truly new or just a confirmation of something that has been predicted for a long time. If you want to become a successful investor, then you must practice looking beyond flashy headlines to search for information the market has not seen yet, or information the market has misjudged, because that is where the real opportunities lie. In this chapter 2, we have together removed one of the biggest traps of news and events. We have understood that the market does not react to what happens today, but it reacts to what it expects to happen tomorrow. In the next chapter, we will delve deeper into another equally fascinating aspect of market psychology, which is the overreaction of the crowd and why the market has such erratic fluctuations. Join me in continuing the journey of exploring the fascinating world of stock market psychology. Chapter 3: Anatomy of Fear or Panic. This is one of the scariest but also most important aspects to understand, which is the anatomy of fear, or more accurately, panic, when the market crashes. This is not just an economic term, but an extremely powerful psychological state that can turn the most rational investors into people acting on pure instinct. Have you ever experienced that feeling when you look at the trading screen and see your account balance evaporating bit by bit, and then, in large chunks? If not, then you are very lucky. But if you have, then you will understand what I am talking about. Usually, things do not start with a big bang, but begin with whispers. Initially, it is just anxiety when there is some bad news or an economic indicator that is not as expected, or a major blue-chip stock suddenly drops slightly. People start buzzing on forums and chat groups with questions like, "Should I sell?" or "The market does not look very good." At this point, the psychology is still controllable, and we still think it is just a small correction. Then comes doubt when consecutive down days appear, causing the green screen to turn bright red. Articles start using stronger words like recession or potential crisis. Your investment portfolio begins to show clear dents, making you doubt your own strategy, along with the information you trusted, with questions like, "Am I wrong?" or "Should I cut my losses?" And when the pressure is high enough, when every number is dyed red, and when negative news floods every corner of information, that is when true panic breaks out. It is like a forest fire when a small spark starts, then spreads and flares up uncontrollably. A churning feeling in the stomach, along with a rapid heartbeat, pushes reason back by a primal instinct to escape the danger. At this point, the decision to sell off is no longer based on analysis or based on the initial plan, but merely a body reaction wanting to protect itself from pain. People sell regardless and sell desperately, which pushes the market into a free-falling downward spiral. Seeing others sell makes you sell as well, because fear spreads like an extremely toxic virus. And here is the most interesting thing of all, a psychological truth proven by behavioral scientists that the pain of losing something is usually twice as large as the joy of gaining it. We call that loss aversion. Imagine that you win 1 million dong from a successful trade, so you are happy and excited, and that is great. But if you lose 1 million dong from a failed trade, that feeling is not just equal sadness or regret, but it is a torment, along with a remorse and an annoyance that lasts much longer. Evolutionarily speaking, protecting what you already have is more important than risking to have more. In the wild, losing food or shelter could mean death, while having a little more food, although good, is not as urgent as protecting what is currently owned. This psychology is still deeply ingrained in our genes, and it is strongly activated when we see our assets threatened. When the market crashes, you not only see yourself losing the virtual profit you once had, but you also see yourself losing capital, which is what you have worked hard to accumulate. This pain multiplies manifold, making it extremely difficult to stay calm. So the question arises, as to how we can avoid being caught in that panic spiral, and how to keep a cool head when everyone around is shouting and selling off and evaporating assets. This is when we need psychological tools and discipline. First of all, you need to have a clear plan and stick to it, because this is the most important tool. Before the market fluctuates strongly, sit down and establish a clear investment plan about what you will buy, what you will sell, at what threshold, and most importantly, what you will do if the market drops 10%, 20%, or 30%. This plan must be written down, and you must commit to following it, because when the market crashes, emotion will be enemy number one. Do not make decisions based on momentary emotions, but based on a plan that was built rationally beforehand, since this is not the time to experiment, but the time to comply. Next, you need to understand yourself and your risk tolerance, because everyone has a different pain threshold. How many % of assets can you accept losing before feeling extremely anxious and unable to sleep? Understanding your own limits helps you make appropriate investment decisions from the start to avoid over-investing in risky assets. If you cannot tolerate strong fluctuations, then do not pursue hot stocks or highly speculative assets. Besides that, practice separating emotions from actions, because when you see your account balance decrease, your heart will beat faster, since that is a natural reaction. But you can learn to observe those emotions without allowing them to control your actions by taking deep breaths, stepping away from the screen, or doing something else to give your mind a rest. Do not check the price constantly, because the voice of fear will tell you to sell, while the voice of reason will tell you to wait and review the plan. Additionally, a long-term vision is also very important, because you need to remember that the market always has cycles. After downturns, the market always recovers and grows again, as history has proven. Times when the market crashes are often golden opportunities for investors with a long-term vision and enough patience, because instead of selling off, they can buy good assets at a bargain price. Finally, education and knowledge. Because the fact that you are watching this video and learning about market psychology is an important step. Understanding the mechanisms of fear and understanding loss aversion helps you recognize those psychological traps and prepare better to deal with them, because knowledge is your most powerful weapon. Dear friends, the financial market is not just numbers and charts, but it is a mirror reflecting human psychology with all its hopes, greed, and especially fear. Understanding these mechanisms does not mean we will never feel afraid, but it will help us control that fear rather than letting it control us. Prepare thoroughly and have a solid plan, and most importantly, understand yourself because that is how we overcome market storms and see the clear blue sky again. In the next chapter, we will explore another aspect of market psychology opposite to fear, which is euphoria and its traps. Chapter 4: Greed and the Genius Illusion. Imagine a morning when you wake up and drink a fragrant cup of coffee, then open the electronic board to see your account continue to increase. The stock you bought last week has increased by 10%, while the code you bought last month has increased by 30%, making everything seem as if it was arranged for us to win. This is not just luck, but a soaring feeling of success, along with superior intelligence. In prolonged bull market cycles, the boundary between luck and talent gradually becomes blurred and then disappears completely. The most interesting and also the most dangerous thing is that we, the participants in the market, very easily confuse these two concepts. When the market is in a strong upward trend, then most things you buy tend to increase in price, whether you have experience or not, or whether you analyze carefully or just follow trivial advice on social media, then the high probability is that you will still make money. It is as if you throw a coin into the air and it always falls on the head side. So after a few times like that, you start to believe that you have the ability to control gravity, or at least possess some kind of golden hand. I remember once, during a very strong uptrend a few years ago, a friend of mine, although having absolutely no experience with stocks and not even knowing what PE was, started investing based on tips from a chat group. He won whatever he bought. So initially, he only bought a little. But then, when he saw money coming in continuously, he began to confidently declare that he had a special talent for stocks. He believed that he had decoded the market and that he was a forgotten genius. Fred Schwed's book has described very clearly the phenomenon of growth markets hiding all mistakes, because a boat going against the current can still move forward if the flow is strong enough. In a bull market, even the worst investment decisions can bring profits, making investors believe they are talented strategists rather than just someone being swept away by the current of euphoria. When you already believe you are a genius, then what happens is very simple, as you will trade more, because the feeling of winning is addictive. Each time the account increases, then dopamine in your brain is activated to create an irresistible loop, going from winning to confidence, then trading more to win again or think you win, then leading to even more confidence. From a cautious investor, you turn into a reckless player when you no longer study the business carefully or care about the basic factors and no longer think about risk management. Instead, you focus on having to do something so as not to miss an opportunity. So you start using margin or high leverage or selling other assets and even borrowing to pour into the market, because this once-in-a-thousand-years opportunity cannot be ignored. Schwab calls this overconfidence, which is a sweet poison that makes us not only trade more, but also place larger bets on uncertain investment ideas. We do not accept mistakes. So when there is an unsatisfactory transaction, we tend to pour more money in to average the price or recover, because we cannot accept that a genius like ourselves could be wrong. This overconfidence distorts our perception of risk and makes us believe we are immune to failure. So how do we know when greed has reached its peak? Then this is an extremely important question, and the book has given some unmistakable signs. First of all are the get-rich-quick stories flooding everywhere when you start hearing neighbors or taxi drivers, along with vegetable sellers and even grandmothers, talking about this stock code or that stock code. Stories about someone doubling or tripling their account in just a few months spread with lightning speed, making people start quitting their main jobs to become full-time traders. Next is that companies with no profit and even no specific product are still valued sky high, especially penny stocks with low face value, or companies with idealistic business ideas without a solid foundation suddenly skyrocketing without a clear reason while the market PE reaches historical highs. The third sign is euphoria replacing logic, when analysis based on fundamentals along with corporate profits and actual value are ignored so that everyone invests based on rumors or beautiful charts along with the upcoming tsunami. The feeling of fear of missing out, or FOMO, covers everything, making everyone buy at any price. Finally, veteran investors start withdrawing money from the market, which is a subtle but extremely important sign. Experienced investors who have gone through many market cycles, when seeing euphoria along with greed reach the peak, then they usually start silently taking profits and withdrawing money to prepare for an upcoming correction, because they understand that when everyone is a genius, then that is the most dangerous time. Fred Schwed wrote that what ordinary investors consider an opportunity is often what professional traders are looking for a way out of. When greed reaches the peak, then everyone feels smarter than others, and everyone thinks they can beat the market. That is the stage when the market is no longer based on real value, but is based on blind expectation, along with euphoric emotions. Hopefully, this chapter has helped you have a deeper insight into the euphoric psychology in a bull market, and more importantly, helped you identify the signs when greed is exceeding limits. Chapter 5. Independent Thinking or a Quiet Death. The title sounds a bit dramatic, doesn't it? But a quiet death is not a sudden death, but a slow and silent erosion of your account and your faith, leading eventually to giving up. And the root cause leading to this quiet death, according to the book, is your inability to separate yourself from the crowd, as well as your inability to have independent thinking. The goal of this chapter is very clear, as it emphasizes the importance of separating yourself from the crowd, because this is not just a skill, but an art and a quality that every investor needs to cultivate. Let us be honest with each other, because perhaps you have experienced this feeling before when you have spent hours researching a stock through analyzing financial reports and charts and reading news to finally make a buy or sell decision. Everything in your plan was very logical and well-founded, making you feel confident. Then you open Twitter or Facebook, or join investment forums, or simply chat with friends and colleagues, and immediately you see everyone saying the exact opposite, as the crowd is extremely excited about the stock you just sold, or is in total panic about the stock you just bought. Or worse, they are infatuated with a super stock that you have never heard of or consider too risky. Instantly, the seeds of doubt begin to sprout in your mind with questions like whether you missed something or if you were wrong, and why you are going against everyone else. We are social creatures, always longing to belong and be accepted, and the market is an arena that tests that social instinct to the limit. When you go against the crowd, you will face an invisible but extremely powerful pressure, which is the pressure of being isolated and the pressure of being considered wrong and even being ridiculed. This pressure can cause you to make wrong decisions, as you might sell a potential stock for fear of being laughed at when it drops temporarily, or buy into a hot stock just because of the fear of missing out, even though it does not fit your analysis or risk appetite. And that is the beginning of the quiet death for your account. As value is eroded gradually, not by the market, but by your own lack of independent thinking. So how to fight against it? The book suggests an extremely valuable technique that I find has completely changed the way I view the market, which is becoming an observer. Imagine the stock market is not an arena where you have to rush in, but a blockbuster movie playing on a big screen. You are not the main character, and you are not the director or an investor holding your destiny in your hands, but you are merely an audience member sitting in a chair and relaxing with a drink and popcorn to closely watch every development on the screen. When you are an observer, you can see the bigger picture as you see the main characters, who are the large investors and funds, and the secondary characters, who are retail investors, as well as the climaxes like crazy price increases or panic collapses, and the subplots like news and financial reports. You see the repeating motifs of greed and fear, along with the mistakes that people make and the opportunities they miss. The most important thing is that you have no personal emotions involved, so you do not feel euphoric when the price rises, nor do you panic when the price falls, but you merely record and analyze and give an objective assessment. I also made this mistake when I first joined the market because I felt I had to be a part of the game and participate in every development. But when switching to the role of an observer, I realized I became more alert with a cooler head, and my decisions were much more rational. Try practicing this technique by stepping back whenever you feel your emotions being swept away to imagine you are outside the cinema, looking at the big screen of the market. Next is a piece of advice that may sound a bit isolating, but is extremely effective for maintaining your independent thinking, which is, do not discuss your positions with too many people. The first reason is that everyone has a different risk appetite, along with a strategy and a vision. So what is suitable for one person is not necessarily suitable for you. And their advice, no matter how well-intentioned, may not be right for your circumstances. The second reason, and the most important of all, is that it shakes your faith. You have spent time researching and analyzing and making a decision which is your belief. When you share it with someone else, they will offer their perspective, whether they agree or disagree. If they agree, you might feel too complacent and ignore potential risk signs, while if they disagree, you will immediately start doubting yourself, even if your original analysis was sound. Every piece of advice and every contrary opinion, whether good or bad, is a small stone gradually eroding the wall of faith that you have worked hard to build. Eventually, you might act not according to the original plan, or worse, make a decision based on the emotions and opinions of others rather than your own. This does not mean you should not learn or seek advice, because you can share with a reputable mentor or a trusted expert whom you truly respect, or a small group of investment friends with the same philosophy and high discipline. But remember, it is only a few people, and do not turn your investment decisions into a public vote. Faith and independence in thinking are your strongest shields in the market. In summary, in the game of the market, independence is not an option, but a mandatory requirement to avoid the quiet death mentioned in the book. It requires courage to go against the crowd, along with discipline to maintain the role of an observer, and confidence in your own analysis without letting outside opinions shake it. Build faith from within based on your own knowledge and understanding, because only then can you truly survive and thrive in this volatile world. Think about this, and I believe you will see your investment path become much clearer and firmer. Chapter 6: The Art of Cutting Losses, Accepting Mistakes. The overall goal of this section is none other than overcoming the ego to protect capital. It sounds simple, but believe me, because this is one of the biggest challenges you will face on your investment and trading journey. First, let us clarify a fatal confusion, as we are often taught that persistence is a good virtue, with advice such as never give up or pursue the goal to the end. This advice is very true in life, but when applied to financial markets without sobriety, it can turn into a double-edged sword. Persistence in the context of trading is the constant effort to learn along with adjusting strategies based on data and experience. It is the ability to recover from failure, but with a mindset ready to change methods if they are no longer effective. Persistence means you have built a plan, then you test it and see it is not effective. So from there, you persistently find a better plan. Meanwhile, stubbornness is the persistent clinging to an outdated belief, along with refusing to face the truth and closing your eyes to clear evidence that you are wrong. In trading, stubbornness is most clearly shown when you hold on to a growing loss with the blind hope that it will eventually turn around. I have witnessed, and to be honest, I myself have fallen into this trap. There were times when I held a losing position, not because of any new analytical basis, but simply because I did not want to be wrong. The ego and pride were so large that they did not allow me to accept an obvious truth, and that was when we were no longer persistent, but had become stubborn. And what usually nourishes that stubbornness is hope. It sounds strange, doesn't it? That hope is a poison, because in life, hope is necessary and is the motivation for us to overcome difficulties. But in financial markets, it can be a slow poison that we inject into ourselves. You hold a stock that is decreasing in price and tell yourself that, oh well, it will probably recover. Or maybe tomorrow there will be good news to support it. Or this time must be the bottom, so it will bounce up anyway. These thoughts are exactly hope leading the way, and it blurs your reason. Hope makes you delay making decisions. So instead of facing the truth and acting decisively, you wait. You wait for a miracle, along with waiting for the market to change its mind until the loss turns from small to large, then to so large that you have no choice left but to sell off in panic, or worse, to hold the loss until empty-handed. The psychology of hope does not allow you to view reality objectively, so it turns you from a trader or a planned investor into an emotional gambler betting on luck. When you trade with hope, then you have given up control and left your fate to the market, which is an extremely dangerous way to trade. So how to escape the trap of stubbornness and this toxic hope? The answer lies in a golden rule that every successful trader knows by heart, which is that a small loss is insurance for survival. It sounds easy, but is hard to do, because everyone wants to win, and no one wants to admit they are wrong. But think of it this way, that cutting a small loss is not a failure, but an inevitable part of the learning process and risk management. It is like you buying insurance for your house, because you buy insurance not because you want your house to burn down, but to protect you from disaster if something unfortunate happens. Similarly, cutting a loss is the insurance premium so that you can continue to play and so that you still have capital to seek better opportunities in the future. Each time you cut a small loss, you not only protect the remaining capital, but also protect your psychology. A small loss allows you to draw lessons along with analyzing where you were wrong and improving the strategy without being too mentally hurt. Conversely, a large loss not only evaporates capital, but also seriously damages your confidence and decision-making ability. It can make you afraid of the market and lose faith in yourself to eventually give up. Cutting losses requires humility, along with you having to put your ego aside and saying that this time I was wrong and it is okay. It is not a sign of weakness, but a sign of maturity and discipline. Consider it a skill and an art to be practiced, so before you place an order, then clearly define your stop-loss point. That is the boundary you will never cross, and is the promise you make to yourself to protect your capital and your own psychology. In summary, this chapter 6 teaches us that in the market, the biggest enemy is not volatility or sharks, but our own ego. Learn how to accept mistakes, as well as distinguish between persistence and stubbornness, while never letting blind hope lead the way. Protecting capital is the number one priority, because only when capital remains will you still have the opportunity to learn, along with developing and succeeding. Practice the art of cutting losses and consider it a reliable companion rather than a failure. Chapter 7. Who are they? Footprints of the big money. I know that every time the market fluctuates strongly, or when you feel like you have just been inexplicably dumped on, then in our minds, we often wonder who is doing this and who is manipulating the market. That feeling is something I have also experienced many times, as it makes us bewildered, along with angry and sometimes losing faith. But is it a conspiracy theory of some mysterious group of people, or is the reality more complex and at the same time simpler than we think? Let us go into the first point, which is conspiracy theories versus the reality of market manipulation. In fact, if talking about market manipulation in the literal sense, which is bending the law for unjust gain, then it is a prohibited behavior and strictly punished because regulatory agencies are still making every effort to prevent that. However, the feeling of being manipulated that we often feel is not necessarily due to illegal acts, but it comes from a very large difference in resources, along with information and psychology between us as retail investors and them who are market makers, along with large investment funds and giant financial institutions that I often call big boys. They are not necessarily evil people or sitting together in a dark room to devise a plan to blow up the accounts of retail investors. Simply, they are playing a different game with different rules and different advantages. Imagine this as us being small fish swimming in the ocean, while they are giant whales. The whale does not need to intentionally drown the small fish, but its movement alone creates large waves and the small fish can be swept away. The problem is that these big boys operate in an extremely strategic way and take full advantage of the weaknesses in our psychology. That is the second point we need to clarify about how big money takes advantage of the weak psychology of retail investors for liquidity. Recalling psychology. Then, we have greed when the market rises along with fear when the market falls, and a lack of patience as well as being easily influenced by news or the crowd, and then frequently making emotional decisions. These big boys understand this very well. When the market falls into a state of panic with bad news flooding in, then who is the one selling off their assets without thinking is us. And who is the one quietly gathering cheap goods with large volume is them. Conversely, when the market is extremely excited, along with good news, bursting out then, who is the one fearing to miss out, or FOMO, and pouring money in to buy at any price, is again us. And who is the one quietly distributing or dumping goods at exactly that time to sell back stocks collected at low prices to those who are greedy is still them. Market makers need liquidity, meaning they need buyers to sell to and sellers to buy from. So we retail investors are the abundant source of liquidity they need. Sometimes they even shake the tree to scare the monkeys, or shake out to eliminate faint-hearted investors who set stop losses too close by pushing the price a bit lower to trigger stop loss orders and then pulling the price back up again. Or they create false breakouts or fake-outs to trick us into wrong positions with the ultimate goal not being to make us poor, but to profit from the difference in psychology and information. So what do we do to not become bait for these big boys then? That is the third and most important point about the strategy of swimming with sharks, instead of being bait for them. This is not a war, but a dance, because we cannot fight the power of big money, but we can completely learn how to not be swept away by it, and even follow that flow. First of all, you need to clearly understand your own psychology about when you are greedy or when you are afraid, so as not to let emotions control your actions. Next is to read and understand the footprints of big money, by learning to analyze trading volume along with how price reacts at important support or resistance zones. Often, before a major market move, there will be signs of accumulation or distribution of goods, such as unusual volume or special candles, which can be their footprints. Besides that, you need patience along with discipline, because big money is not in a hurry, since they have strategy and time. So learn to wait for truly good entry or exit points and follow your risk management principles rather than jumping according to every news or rumor. At the same time, you should not follow the crowd, because when everyone is talking about a stock or a trend, then it is very likely that the time has come for the big boys to prepare to exit, so you should think independently. Finally, is strict risk management by setting stop losses and clearly defining positions so as never to bet your entire account on a certain transaction. Understanding how they think, along with how they act, is not for us to be afraid, but for us to protect ourselves and seek opportunities. When we no longer act according to emotion, along with when we know how to wait patiently and identify the footprints of big money, then we will no longer be prey. Instead, we will become wiser investors by knowing how to swim with the flow, and even taking advantage of the power of those whales to achieve our goals. In the next chapter, we will go deeper into how to build a trading plan based on market psychology, which is a plan to help you control emotions and make more objective decisions. Chapter 8: Building a Winner's Mindset. A winner's mindset sounds grand, doesn't it? But in fact, it is not an innate gift or a miracle, but a personal construction built from psychological qualities that we will explore right now. This is the synthesis and the compass for us to reshape our thinking. The first and perhaps most difficult quality is patience. It sounds easy regarding sitting still and doing nothing, because who cannot do that? But in the context of the stock market, when every second that passes can be an opportunity or a risk, then sitting still becomes a terrible challenge. Why is it so difficult? Because our natural instinct is action. So when we see a fluctuation, we want to do something like buying or selling or adjusting and changing. This itchiness stems from the fear of missing out, or FOMO, or the desire to fix mistakes immediately. However, the market is not a place to do, but a place to wait. And patience here means you must wait for a clear signal. You should not rush into a trade just because you think it will go up or down, but wait for your system to give a confirmation signal. You also need to wait for profits to run, because once in the right position, then be patient to let profits develop, rather than cutting profits too early for fear that the market will turn around. At the same time, you must wait for the market to stabilize, because there are times when the market is chaotic and has no clear trend, which is the best time to stay out to preserve capital and wait. Think of a professional hunter when they can spend hours or even all day sitting silently in the bushes to wait for the perfect prey to appear. Or look at a gardener who is patiently caring for and watering because they know that seeds need time to germinate and bear fruit. The market is the same. I remember times when my account had no positions for many days or even a whole week. Initially, I felt insecure, as if I was missing out on something, but gradually, I realized it was a kind of active patience to protect capital and wait for the best bullet instead of shooting indiscriminately. That is when you truly control your emotions. If patience is doing nothing at the right time, then discipline is doing the right thing at the right time and repeatedly. Iron discipline is the ability to adhere to an established trading system, along with a planned strategy, despite the tempting emotions or fear rising in your heart. Emotion is the number one enemy of discipline, because greed makes you hold a position too long with the hope that profits will increase forever, only to ignore the exit signal. Fear makes you cut losses too early, or even not dare to enter an order despite a clear signal, while the ego makes you revenge the market after a loss by increasing trading volume indiscriminately. A good trading system that has been tested and proven will be like a detailed map for your journey, and discipline is your adherence to that map. It includes following entry and exit rules without modifying rules midway, along with risk management to never bet too much on one trade and always set a stop loss, then follow it. You also need to record trades to learn from both success and failure. Imagine a pilot when, before each flight, he must follow a strict checklist step by step, even though he has flown thousands of times. He does not rely on feeling or experience to skip a step, because he knows even a small mistake can lead to immeasurable consequences. I remember once I had a trade with quite good profit, and my system had signaled to take partial profit. But I, with the ego of knowing better than the market, decided to keep it all, thinking it would increase further. The result was that the market reversed strongly, and I not only lost the profit part that should have been taken, but also ended the trade with a small loss. That was when I learned that the system is more important than the ego, and discipline is not a limitation, but a release from disastrous emotional decisions. The final quality, but no less important, is humility, to always respect the market. The saying "the market is always right" is not a hollow saying, but a harsh truth that every successful trader must take to heart. Complaining about the market is meaningless because the market has no emotions and no personal intentions toward you, but it simply reflects the sum of millions of buying and selling decisions. Humility helps us realize our position as a small individual in a giant system. When lacking humility, then the ego will rise, making you think you are smarter than the market, and you are never wrong. This leads to stubbornness with mistakes when you hold a losing position too long without accepting that you are wrong, and leads to revenging the market when after a losing trade you try to get it back by entering larger orders along with being more risky, leading to heavier losses. The market will teach arrogant people the most expensive lessons because accepting losses is an indispensable part of the game, and humility helps us accept it calmly to learn from there and move forward. Imagine as if you are facing the ocean when you can be a talented sailor, but you cannot command the waves. You must respect its power to learn how to steer the boat according to the flow, along with taking advantage of favorable winds and knowing when to avoid storms. I once had indescribable phases of stubbornness when there was a time I was sure a stock code had to go up, even though all indicators were showing a clear downward trend. I kept buying and averaging down, thinking I would catch the bottom, but the result was that the market taught me an expensive lesson about never going against the trend, and the price of arrogance was losing a large part of the account. From then on, I understood that humility is not weakness, but the strength to learn along with adapting and surviving. The 3 solid pillars of patience, along with discipline and humility, do not exist independently, but intertwine to support each other. Patience helps you wait for the right time, while discipline helps you act according to the plan. When that time comes, despite emotions, and humility helps you accept results to learn from both success and failure in order to continue being more patient and disciplined in the future. Building a winner's mindset is a long journey requiring self-awareness, along with continuous training and willingness to face the dark parts within oneself. You will stumble along with making mistakes, but the important thing is how you stand up, as well as how you draw lessons and how you continue to sharpen these qualities. Ask yourself if you are ready for this journey, and if you are ready to become a better version of yourself in the market, not just for profit, but also for personal growth. Thank you for listening, and see you again in the next contents to together conquer this challenging financial world. Our journey of exploring stock market psychology has probably made many people exclaim, because what we thought was logic along with dry numbers is actually surprisingly vivid and emotional. This book to me is like a large mirror, reflecting not only the market, but also ourselves. And now, having gone through these profound chapters, I want to summarize 3 things that I believe are most important, which are the 3 golden keys, that if you remember, then you will have a significant advantage in this game. Be ready to recharge your mind. First, you must take this to heart that the market is not a calculator of profit or pure intrinsic value. No, it is not simply the sum of financial reports or P/E ratios or industry analysis. The market, after all, is where millions of people with full ambition, along with fear and hope, along with even despair, are interacting with each other every day. Does it look familiar when sometimes the market skyrockets? Not because that company suddenly has double the profit, but because of an irrational wave of optimism or a FOMO effect, which means the fear of missing out, spreading like a virus. Conversely, terrifying sell-offs are sometimes not due to the economy collapsing, but due to collective panic, along with groundless loss of faith, to then push stock prices below even their real value. This means that you must always look beyond the numbers to ask what the general psychology of the market is right now and how everyone is feeling. Is it extreme euphoria, or is it pervasive fear? When you understand that the market is an emotional organism, then you will be less surprised by unpredictable fluctuations, and more importantly, you will learn how not to be swept away by those collective emotions. Never forget that behind every buy and sell order is a person making a decision based on very real emotions. From the first point we easily move to the second golden key, that the crowd, or also called the majority, is usually wrong at the important turning points of the market. This is a harsh but extremely important truth. Imagine this as when the market is at the peak of an upward cycle, and when everyone is excitedly bragging about huge profits, along with when financial news is flooded with stories about newly emerging millionaires. Then that is usually the time we should be careful. This is the time when the crowd is in a state of extreme euphoria to rush into buying everything without deep analysis. And at that very moment, wise investors begin to silently take profits and withdraw. Conversely, when the market crashes and when indices plunge uncontrollably along, with when fear covers everything, so that everyone wants to sell off to cut losses, then that is when the real opportunity appears. The crowd right now is desperate to sell even good stocks at dirt cheap prices, so visionary investors with a cool head start to collect goods. I have made this mistake many times due to being swept away by the wave of the crowd to buy when everything was too hot, or sell when everything was too cheap. This lesson reminds us of the importance of critical thinking, along with maintaining a stance when facing pressure from the majority. Remember that large profits often come from going against the crowd rather than from following them, because nothing is easier than blending into the majority, but nothing is more difficult than standing firm alone. And this leads straight to the final key, which is also what I consider the most important of the three keys, which is that controlling personal emotions is more important than any technical analysis or fundamental analysis capability. Imagine you have the most modern F1 racing car in the world with a powerful engine along with perfect grip tires and all the most advanced technology. That car is your analytical knowledge when you can draw charts along with reading reports and calculating everything. But if the driver, who is you, is an impatient person, or easily panics, or is overconfident, then what will happen? That car can have an accident at any time, regardless of how good it is. Similarly, you can be an analytical genius when understanding every indicator along with every candle pattern and every financial number. But if you do not control fear when the market drops leading to selling good stocks, or do not control greed when the market rises, making you buy risky stocks at too high a price, then all that knowledge will become meaningless. Controlling emotions does not mean you do not have emotions, because we are humans and not robots. Controlling emotions is the ability to identify those emotions, and more importantly, the ability to not let them dominate your actions. It requires discipline, along with patience and a clear trading plan that you follow strictly. It is about you knowing when to stop along with when to wait and when to act, despite the inner voices screaming. This is the inner war that every investor must go through. These are not just lessons from a book, but truths that have been proven over centuries of trading, which are the compass for you to navigate in the maze of the market. Meditate on them along with applying them to reality, and I believe you will not only be a better investor, but also a person with deeper understanding of human nature. And so, we have gone through a challenging, but also extremely enlightening journey together to discover the psychological corners hidden deep in every investment decision on the stock market through the book, The Psychology of the Stock Market. If there is one thing I want you to take away after listening to these analyses, then it is not some magical formula for getting rich quickly, but a deeper insight that stock investment, which is deeper than red and green charts or profit figures, is actually a non-stop journey of self-cultivation. In fact, the stock market is like a mirror reflecting ourselves, because it not only tests your financial knowledge, but also digs deep into your courage along with patience and greed, as well as fear and even cognitive biases that we are often not aware of. How many times have you found yourself wavering between FOMO, or the fear of missing out when the market heats up, and FUD, including fear along with uncertainty and doubt when prices drop sharply. How many times have you held onto a losing stock with fragile hope or sold a potential star too early just because you wanted to take quick profits? That is when the market is teaching you an expensive lesson about human psychology, along with how we react under pressure and uncertainty. I myself have also gone through countless such moments, from times of overconfidence and then falling off the horse to times of flinching out of fear and missing opportunities. Each time like that, not only was the account affected, but more importantly, I learned something about myself. I learned how to control emotions, along with how to set clear boundaries and how to accept the inherent uncertainty of the market. This is not just an investment skill, but also a life skill. Because understanding market psychology, after all, is understanding yourself and understanding crowd psychology, which is an invaluable skill not only in finance, but also in every aspect of life. And now, I want to hear your story regarding which is the most expensive psychological lesson you have ever had to pay for in your investment journey. This does not necessarily have to be losing money, but could be a moment you realized how you let emotions dominate, or an impulsive decision, or a repeated mistake, just because you could not overcome a psychological barrier. Please share your story in the comments section below, because I believe that each story is a valuable lesson. And when we share together, then we will learn together to grow together and build a firmer community of investors in both knowledge and psychology. And if you find these shares useful, along with if you feel inspired to view investing through a deeper lens, then do not forget to click the subscribe button for this channel. This is where we will continue to explore other classic books, so please click subscribe so as not to miss any episodes, and turn on the notification bell as well to be the first to receive news when there is a new video. Remember that the stock market is not a place for you to get rich quickly, but is a playground for you to become wealthier in terms of money, along with wisdom and patience, as well as self-control. It is a long-term journey that requires non-stop training. Thank you for taking the time to listen and accompany me in this episode. See you again in the next episodes, where we will continue to expand our vision and equip ourselves with more precious knowledge to be firm on our investment journey. Wish you always stay calm and successful.